Hello guys. In this video, we'll talk about the diversification. We want to look at why it's important to have a diversified portfolio and how diversification works. And the second objective is we will look at what is efficient frontier and what is the importance of the asset allocation. We allocate the asset our investment in different assets, so how we should allocate it optimally in the way where we should have maximum return and the lowest risk, because we want to get more return and we want to get like at the same time we want to undertake lowest risk. This is against the principle of higher the risk, higher the return, but our aim is eventually to we want all more return, but at the same time the lower uh, return. Lower risk. So if you see this table I have, and this table is taken from a very popular article from published in one of the elite journal of finance, journal of financial and quantitative analysis, and written by Mere Statement. And he used the data before 1987 and randomly selected one stock from the New York, traded on the New York Stock Exchange. And you can see in the first column, it is written that number of stocks in portfolio. So when he randomly, this is important, one stock, the standard deviation of the portfolio, which is actually also the happens to be the standard deviation of the stock, because there was only one stock in the portfolio, was 49.24%. The third column was basically the ratio of the portfolio standard deviation to the standard deviation of a single stock. So if you divide the portfolio standard deviation with the standard deviation of the portfolio with the single stock, you will get the numbers over here. So for the first row, this one, you obviously divide 49.24 with 49.24, you'll get one, right? So when he selected two random stocks, randomly selected two stocks from traded on the New York Stock Exchange. So 37.36 was the standard deviation of his portfolio. We can see that as he started increasing the stock, this is the main point, the standard deviation of the portfolio started decreasing. So if he would have just invested in one stock, the risk was high compared to the when he has a portfolio of the two stock. So the standard deviation, which is the measure of the risk of the portfolio, is is actually less, 37.36 versus 49.24. And if you simply divide 37.36, which is the standard deviation of the portfolio of the two stock, with the standard deviation of the portfolio with one stock, which was 49.24, you got 0.76. So if you see, you can, like, the main point is over here is this, that the stocks, when we start randomly selecting these stocks and put in our portfolio, the standard deviation of or the risk of our portfolio start decreasing. But there is a limit to that. If you see, after adding 30 stock, like, it does not make much difference if he started adding more stocks, 40, 50, 100. When he has a 30 stock, you can see that the standard deviation of the portfolio was 20.87%. So remember, this is the standard deviation of the return of the portfolio. Whenever we are talking about the standard deviation of the portfolio, it means it's the return of the portfolio. And 0.42 is the ratio of the standard deviation of the portfolio with 30 stock to the standard deviation of the portfolio with single stock, which is 49.24. So simply 20.87 divided by 49.27, you will get 0.42. So if you then he added 10 more, he selected randomly 10 more stock, and you can see that standard deviation did not like decrease like much. It's not a significant decrease. And as he started adding more and more and more stock, at one time there is no effect, like no difference at all. Like for example, if he has 100 stock and then he has the standard deviation of 19.69, and if he'll add 200 stocks, 100 more, the standard deviation was 19.42. So the main point was this, that diversification help. When you start investing in different stocks, it help you to decrease the overall risk of the portfolio. And this is what we are like, we are more concerned about our portfolio now rather the individual stock within the portfolio. We want the return of the portfolio high and at the same time risk of the portfolio low. So if you'll start investing in more stock, then it will definitely decrease the risk of your portfolio. But at the same time, you should know that if you overly diversify your portfolio, it won't help you. So the marginal benefit basically is not much more than the marginal cost. You might have to pay, like you have to manage so many stocks within the portfolio. You have to pay for the trades. It won't work, won't help you if your sole purpose is to decrease the risk of the portfolio. So in this case, if you make a portfolio of 30 stocks, that more than enough to decrease the or substantially decrease the risk of the portfolio compared to the situation where you are investing only in one stock and undertaking or exposing yourself to a much higher risk. In this case, it was 49.26. Now, it also depends that what like year of data you are using. In the previous article by Stateman, he was using the data up till 1987, right, or before 1987. When this analysis was rerun with the data from 1987 and till 1997, for next 10 years, the researchers found that the more diversified portfolio is created if you will have now 50 stocks, right? So, but that's for sure that somewhere between 30 to 50, if you have the portfolio, you might have much more diversifiable portfolio. Now when you start adding the stock, this picture is very important, that when you start adding at one point in time, your risk will not reduce further. You see this the like orange or brown sort of a area over here. So this is the overall risk on the y-axis, and you have on the x-axis the number of stocks inside the portfolio. So when you have one stock, there is much higher risk. When you have 2, 3, 4, and you started increasing, this curve started decreasing as well. Like it's basically you can see it's a steep decline. But at one point in time, somewhere between 20 and 30, this curve is almost getting flattened, right? So this is suggesting that there is two risk. One is diversifiable risk and the other one is non-diversifiable risk. So the diversifiable risk is that risk which you can reduce by adding more like stocks in your portfolio. And remember, these stocks has to be from different segments, different industries. It could be a like it should like the stocks inside your portfolio should not be from same line of business. It is also important that you can have a like growth stock, a mixture of growth and value stock. You can have a mixture of large cap and low cap stock, like the company which has large capitalization or the company which has low capitalization. The main point is this, that those stock should have been randomly selected so that you are not biased, say, only towards the growth companies. If, say example, if you would have a growth stocks only in your portfolio, what would have happened, or the in dot-com bubble, when you simply have only IT stocks, say, in your portfolio, your portfolio will definitely suffer. But if you have these in your portfolio stocks from different industries, like, then in that case you are able to effectively diversify your risk, and your portfolio will be truly diversified. So this pink area, or like over here, I'm not very good in colors, so I'm just saying I think like it's pink, might be something else, but you can see that this risk area is reduced when you started adding more stocks. So if you have more stocks in the portfolio, so the diversifiable risk will go away, which is firm specific risk. What sort of risk is this? For example, you have a stock in your in your portfolio of say Google, and tomorrow some harassment case like comes up against the president of Google. I'm just giving an example. In that case, might be because the Google might have to terminate his contract, and investor might be thinking that this president is was really leading the Google to its glories. And in that situation, investors becomes very doubtful about the future leadership, and the might be the stock price of this of the Google will decline. So this is truly a firm specific risk. And if you have more stocks from different companies in your portfolio, that might cancel out by some pleasant firm specific news from some other stock. But there are few risks which is a market risk which you cannot diversify. That does not matter how much diversified portfolio you have, that risk cannot be eliminated, right? We also call that the non-diversifiable risk or systemic risk, right? So in that sort of risk cannot be taken away, right? For example, what happened in pandemic. So when I do remember, right, in March 2020, in the middle of the March, when the pandemic truly was at its peak throughout the world, and Italy was actually getting suffered a lot at that time. So the market reacted negatively. Does not matter how good few companies were, still their stock declined. So so pandemic is actually a risk which market cannot avoid, which any firm cannot avoid. So this market specific risk cannot be eliminated, and the market actually compensate investors for bearing that risk, but not bearing the firm specific risk. So market assume that you are a well diversified investor. You have invested in different stocks. You have a very diversified portfolio, randomly selected from different industries, different type, growth value growth stocks, value stock, the small cap stock, large cap stock, and you have well diversified portfolio. So they will not compensate you for undertaking the firm specific risk. They will only compensate you for undertaking the market risk. So this is important point to remember. But the main point is this, that how the diversification works, and we will look into it. Before going into that, one thing is important to mention, which is called the fallacy of the time diversification. You might have heard that many young investors will hear about this investment advice, that you should invest in the equities. This is our right advice, but usually the argument which is given, it's not right. Like for example, it's said that if you invest in the equities in a particular year, you might have a steep decline in your returns, but over the period of time you have high return as well. So those volatilities will cancel out each other, and you will end up getting high return. It is actually not like this. The main thing over here is that uh, when you are a young investor, and there are one or few years of steep declines, you have enough time to like to change your habits in such a way to that where you will be able to make up your loss. You will start might be earning more by doing two jobs. You might decide to go and get higher education and go into a well-paying job, or you simply start working more. uh, so you have enough time where you'll be able to make up your loss which you have earlier experienced. But for a person who is near retirement, his capability or to earn more start decreasing. That's why the people who are near their retirement, they have been advised to make a portfolio where there is a enough securities, fixed income securities, and they should not totally invest in the equities, because if now near retirement, if there is a steep decline in their return, or they lose money, it would be very hard for them to make up for that money. So this is actually the policy of time diversification. Now the main thing is why diversification works. Key concept over here is the correlation between the returns of assets present in the portfolio. So correlation is simply the tendency of the return on the two assets to move together. So if two assets, if based on one asset, I can predict the return. So based on the return of one asset, I can predict the return of another asset. Those two assets considered to be correlated. Now, if one asset start going up and I can clearly predict that the other asset will also go up, we will say that these assets are positively correlated. So positively correlated assets, they tend to move up and down together. So when the other one will go down and I can, from its movement, I can predict that the other asset can also go down, then yes, they are positively correlated. And in negative correlation, they start moving opposite. But I can predict when the one asset start going up, the other is going down. If I can predict that, then the return of these two assets are negatively correlated. When I'm talking about again assets, when one asset is going up, I mean to say that the return of one asset. So when the return of one asset is going up and I can predict that the return of the other asset will go down, they are negative correlated. And if there is no relationship between the return of the two assets, then there is no correlation at all. So the range of the correlation is between -1 to +1, where 0 represent, because -1 and 0 is right in between the -1 and +1. So 0 represent no correlation, +1 represent perfect correlation, perfectly positively perfectly positive correlation, and the -1 suggests that it's perfect negative correlation. So one point also is important to remember over here. Like the return of one asset can predict the return of another. If there is a perfect correlation, means +1, perfect positive correlation means +1. It does not mean that the magnitude, that the other return of the other asset will move by the same magnitude as the return of the first one. So if the say return of the first one is +1, like it's 1%, so one asset return increased by 1%. Now I can predict that the other will go by 2%. They are still positively, perfectly positively correlated assets. So correlation is the main thing. The correlation is denoted by this one. So this core RA, RB, suggesting that it's a correlation coefficient, and it can also be written as rho AB, right? So the correlation coefficient measures correlation and ranges from -1 to +1, where -1 is perfect negative correlation, +1 is perfect positive correlation, and right in between 0 suggests that they are not correlated. And this is actually the correlation because of which the risk of the diversified portfolio, return of the diversified portfolio, is less than the return of the individual assets present in the portfolio. Now important thing to remember is this, that if you want to get the maximum benefit of the correlation of the maximum benefit of the portfolio by having less risk, in that case the return of the assets inside the portfolio should be perfectly negatively correlated. So there should be -1 correlation between the return of the assets inside the portfolio. But in reality, the the return of the assets tend to move together. So whenever the market moves up, and there are booming periods, economy is doing fine, most of the assets actually start giving you positive returns, so they move with each other. And if something happens like what happened during the COVID-19, then if one start like because they tend to move with each other, so the returns are basically they follow the same pattern. So if there is a loss on the return of one asset, there might be a loss on the return of the other asset as well. So there will be a loss on both assets or three assets. So mostly in stock market, returns are positively correlated, but not perfectly positively correlated. Because if it's perfect positive correlation, in that case there is no benefit at all of the portfolio, because if the market goes down, everyone will go down, right? So the main point over here is this, that as long as the correlation between the returns of two assets are not perfect positive correlation, if they are not perfect positive, then in that case we can still reap the benefit of the diversification. One thing over here, that how it works, it can only be seen from the formula. I'll show you the formula in the next few slides, where you'll be able to understand that how, even say if there is a positive correlation of 0.5, but still we will be able to we will be able to reap the benefit of the portfolio diversification, because the correlation between the returns is not perfect, right? They are not perfectly positive. So if they are, the maximum benefit will only come from the perfectly negative correlation. That's the main thing, -1. That's ideal, but usually it's not the situation. So the return of the assets, they usually tend to move together. So mostly there is positive correlation, but the main thing is this: we do not want them to be perfectly positive correlated. So if they are not perfectly positively correlated, then it's fine, right? So if even it's a 0.8, which is very high, it's suggesting still that it's a highly positively correlated, but still not perfectly positively correlated, because 0.8 is less than +1, right? In that situation, still there will be some benefit of the diversification, because they are not perfectly positively correlated. So only in that case where the diversification or the portfolio simply won't be able to help you, if the return of the assets inside the portfolio, they are perfectly positively correlated. If they are not, even if still they are positively correlated, this is very important point to remember, then still we'll be able to reap the benefit of the of making a portfolio, because there is still some element of diversification, and we will not be putting all the eggs in the same basket. So look over here. This is sort of a picture where you have perfect positive correlation. This is sort of a picture where you have a perfect negative correlation, and this is simply the zero correlation, right? So now look at this thing. So just pause the video over here. So this is the return of stock A. So all this thing over here from 2006 to 2010, and stock B, and calculate their average returns and standard deviations. So simply feed the number, and you will check that the average return is this for stock A over these 5 years, 2006, 7, 8, 9, 10, and it's 13% for stock B, and standard deviation is 14.3 and 13.5. Now over here we have a portfolio, equally weighted portfolio of A and B, means half of your money is invested in stock A, and if half of the money would have invested in stock B, then you will get these numbers over here: 2006, 2007, 2008, 2009, 2010. So simply multiply 0.5 with 10 plus 0.5 with 15, you will get this. Likewise 0.5, because it's a portfolio weight, half of your money is invested in stock A, that's why it's 0.5. So 0.5 multiplied by 30 plus 0.5 multiplied by minus 10, you will get 10% over here. And likewise all the way up till 2010. And then like what you have done with stock A and B, add all these numbers divided with by 5, and this is your average return, 11% over here. And standard deviation, do the calculation. I just as a in order to review the things, I can show you this calculation also over here. Just give me a second. So look over here, turn on your financial calculator, BA2 plus financial calculator. So I'm going into the data. There is some value already entered, so I'm clearing it up. And what is your 2006 return for the portfolio A and B? Means where the it's an equally weighted portfolio where 50% is invested in stock A and 50% would have been invested in stock B in 2006. So that this will give you the 12.5%. So X1 is 12.5%. This is only one variable we are talking about, which is the return of the portfolio A and B, right? So enter. There is no Y1 over here. There is no other return. So then you have X2, which is 10%, X3, which is 7.5%. You have X4, which is 2009 return of the portfolio A and B, which is 12.5%. Sorry guys, it's 0.5. Enter. And then you have, remember Y04, there is no other variable, only one variable we are talking about, which is the return of portfolio A and B. And your 2010 return, which is X5, is 12.5%. Always double check your number. I always double check my numbers. So in the exams, it's always helpful, right? So compute stats, and it's one variable. We are talking about the return of portfolio A and B. So the mean is 11%. This is the same 11% you are getting over here, right? So your mean is 11%. And over here, we will not be looking at the population standard deviation. We will be looking at the sample standard deviation. So when we are doing our calculation based on the historic data, then it's, which is like over here, 2006, 7, 8, 9, 10. Then we use sample standard deviation. When we use the probabilities, when there are probabilities, then usually we see the population standard deviation. So this is the sample standard deviation, which is 2.2%. Now you can see over here the main point. So if you want to calculate the standard deviation of stock B, this is the same way you will be able to do it, but then these inputs obviously are different: 15%, minus 10%, 25%, 20%, 15%, right? And you will get these results in your BA2 financial instrument calculator. So the main point over here is, look that the return of the portfolio is higher than the stock A if you would have invested everything in the stock A, right? 11% versus 9%. And look at the difference between the risk if you would have invested in stock A versus if you would have invested in portfolio A and B, where you have equal investment both in stock A and B. 14.3% versus 2.2%. So risk which you have undertaken is much less compared to if you would have invested in stock A. Likewise for stock B, even though stock B is giving you 2% more return, but the risk for undertaking the investment in stock B is much higher, 13.5% versus 2.2%. So this, you can see that the data is suggesting that it is a real possibility that that the portfolio reduces risk. If you will invest only in one stock, you are actually undertaking a big bet. You are saying that, okay, if I'll be having a good return, it's fine, but what if the returns will not be good? In that case, you are exposing yourself to much more risk. Worse is the situation where if you invest and start making invest in different assets and start making a more diversified portfolio, then return can be, if it is more, not more, but at the same time there will be much less risk. So the compensation for for undertaking this level of risk is relatively much high. So main thing over here is also this, that the markets do not compensate you, and they obviously assume that you have a well diversified portfolio. They do not compensate you for the firm specific risk. They will only compensate you for the market risk, the risk which you cannot avoid. By all the stocks are exposed to the same level of risk. The measure of that risk will be beta, and I will discuss at any time in future in some other video that what is beta in detail. But the beta is give you the level of risk for which the market compensate you, not the standard deviation. So this is important point to remember. But over here I will be still be talking about the standard deviation. Now, one thing, if you see that if the return is high but the risk is so less, what does it telling you? From my previous slide lecture, where I was telling that it's actually the correlation. And if your correlation is not perfectly positive, if the return of the two assets are not perfectly positively correlated, then good, you are, it's a very good situation. So here we can easily see the level of risk which is generated by the portfolio of these two assets is way less than uh, the way less than the risk of the assets. So sorry, I think I moved on some other slide. I have to go back over there. Yes, this one. So it's the risk is much less for the portfolio compared to the individual assets. So just looking at this, I know that the portfolio, the return of the assets, which is A and B, there is a definitely highly these returns are highly negatively correlated. We can check that as well. So look over here. I'm again going into the data. I'm clearing my yes, I'm clearing my work. Now my x1 is the return of stock A, and the y, all the x's are my return of my A, and the return of my B, of the stock B, is actually the y variable. So x is 1 is 10% because this is the return of stock A. Y1 is 15% at the same time. X2 is 30%. Y2 is minus 10%. X3 is minus 10%. This is X3, right? 25% is my Y3. X4 is 5%. 20% is Y4. And finally, 2010 stock A return, which is X05, is 10%. And for the stock B, it's 13%. Right? So second stat, now I have to go to the linear regression function. So second enter, now I am entered into the this function, and now I'll press the down arrow. So you can see that this one, sorry, over here, this is the correlation. So the correlation is actually minus 0.96, almost really perfectly negatively correlated. So this is suggesting that that this is the reason why the risk of the portfolio A and B is much less compared to the individual assets risk. You can pause the video and enter the data. I just paused the video, and basically instead of 15%, I actually fed 13%. So actually the correlation is minus 0.95 rather minus 0.96. But you can double check it, feed all these variables, all these returns of stock A as X and stock B as Y, and go into the linear function, second data, this one, and go down and check your number over here. So this is the, sorry, this R is the correlation. So which you'll get from the BA2 instrument, BA2 plus calculator, Texas Instrument BA2 plus calculator. Now, if you see, this is the formula how you basically get the variance of a portfolio. And if you take the under root of the variance, then you will get the standard deviation of the portfolio, which is the measure of the risk of the portfolio. So for a portfolio of two assets A and B, the variance of the return on the portfolio is this, is given by this formula, this one, this thing over here, right? So this is, if you see that you have the square of the weight of stock A into the variance of stock A plus square of the weight of the portfolio weight of stock B into the variance of the return of stock B. Or again, all these are returns, right? We are talking about. This is the 2 into weight of portfolio weight of the stock A into portfolio weight of stock B into the standard deviation of the return of stock A, standard deviation of return of stock B, into correlation between the return of stock A and B. If you see all these terms, so this term, this one, all these will generate positive number. This will generate positive number. This will generate positive number. This will generate positive number. Right. Obviously, all these square, even if you have minus, by the way, weight cannot be minus, and also the variance cannot be minus. But even if something is minus, mathematically this will generate positive number. So by no way this can be negative, right? This term can become only be negative if correlation number one can be negative, right? So 2, whatever is the weight of stock A, weight of stock B, standard deviation of the return of stock A, standard deviation of the return of stock B, into, now this, up till this thing, everything will be positive. This, only this term becomes negative if correlation can be negative, or this number will basically generate a lower number if the correlation become into decimals, like if it is not perfectly 1, right? If it is 1, the whole this number will come as it is. But if it is less than 1, say 0.5, let's suppose if this is 0.5, then whatever is the number over here, say if it is 4, then 0.5 multiplied by 4 will generate 2, right? So the correlation only reduces the magnitude of the variance. So this is technically how the the diversification is working. The diversification main benefit is to reduce the risk of the overall portfolio, and the portfolio risk can only be decreased because of the correlation. This is the main element. If the correlation is negative, very good. Anything below 0 is very good. And the best situation is where you have a correlation between the return of the two assets, which is -1. But even if it is positive, anything below +1, right, you still have some benefit of the diversification. Yes, not much, but still better than if the correlation is +1, because if the correlation is +1, then there is simply no benefit of the diversification. So might be some conservative investor thinking that why not if I simply invest everything in the bond mutual fund, where the all the investment is in the bond and there is a guaranteed return. So it's very conservative thinking, right? So we will see that whether this decision is a wise decision or not, right? We can see that. So for that, I have opened up my I created an Excel sheet where I will show you some calculations. Look at this Excel sheet over here. This sheet is showing us that how important is the asset allocation. There is an investor who is facing a situation where if he invests everything in the stock, his expected return will be 12% and his risk will be 15%. and if he invests everything in bonds, his every over here everything is in bond, this is the bond investment, then his expected return is 6% and his risk is 10%. So let's start over here with the situation where if his portfolio weight for investing in stock is 100%, means it's 1, and the bond is 0, so obviously this is what he'll get. And now we will start investing 5% with the increment of 5% in bond. Obviously we'll be decreasing 5% from the stock weight, so it's 0.95, which means 95% in the stock, and the bond weight is 5%. In that case his expected return is 11.7%, which we know how we got. We simply got it if you will multiply 0.95 with the expected return of the stock plus 0.05, which is 5%, with the expected return of the bond investment, which is 6%, right? So this is the answer you will get over here, 11.7%. And the standard deviation is simply the under root of the variance, and we have the formula for the variance, and this is actually the formula, right? This one over here, this one, second line, right? If you use this formula and take its under root, then or square root, then you will be able to get 14.31. So it makes sense because you have taken the investment away from a risky asset which was giving where we have 12% expected return and 15% the risk, and 5% is now allocated to the bond. So it makes much sense that you have invested into relatively less risky asset some part of your portfolio. Now if you keep doing it, you will see that expected return increase and is increasing, and the risk is decreasing over here, but up till a certain point. For example, you can see that over here you have a decrease in up till here 8.69, there is a decrease in the risk, but after that the risk start increasing. So now if you invest more, for example, from this barrier line where there is actually 30% invested in the stock and 70% invested in the bond, after that if you invest 5% more in the bond, which means 75%, and 25% in the stock, your risk increase from 8.69% to 8.71%, and at the same time you have a low return, which makes sense. But the main thing is that even investing beyond this point into a less risky asset, which is bond in this case, uh, will not generate actually the low risk for the portfolio. In fact, the risk started increasing. So it means that the portfolio allocation matters. So person who might be thinking that he should invest everything in the bond, he's a very conservative investor, like this decision turned out to be basically wrong decision, and he should find a relatively good weight where weight of like portfolio weight for both of these assets, where he can get the maximum return for the given risk. So in this case, uh, I actually forgot to mention, because you have to also use the correlation. The correlation is taken as 0.1. So 0.1 is the correlation, and if now you use over here in this formula, you will see that that the asset allocation matters, because even after a particular point in time, if you start investing more and more into the less risky asset, it is not necessarily it will not necessarily generate the low risk for the portfolio as well. So asset allocation in the asset allocation within the portfolio matters a lot. Now the the thing is this, that you need to know that if you are a very conservative investor, then where you want to invest. Obviously this is the graph where I have basically plotted the expected return of the portfolio, all these things, versus the standard deviation of the portfolio. So standard deviation is on the x-axis and expected return is on my y-axis, and this is the graph over here, right? So you can clearly see that this is the lowest point. This is the point where you have the minimum risk, and this is called the uh, uh, minimum variance portfolio. So this is the minimum variance portfolio, and over here you can see that where is the minimum risk. So you can simply eyeball and you will find 8.69 is the lowest, and versus that 7.8% is the expected return. So you can, even from eyeballing, you can see that it is the risk is just above like 8% over here, and then this is the return over here somewhere between the 6 and 8%, but this is the exact number, 8.69, 7.8. So this is the minimum variance portfolio with the available like choices which we have over here, and this curve is called investment opportunity set, because this investment opportunity set is giving you the possible uh, expected return and the risk based on the different weights, the weights, asset weights, by which we can build up this portfolio. Now, one important thing is this, that if for a given level of risk, anything below this minimum variance portfolio over here, below anything below that, that is basically undesirable portfolios. You do not want that portfolio at all. So these are inefficient portfolios. You need only the efficient portfolio. So all efficient portfolios are basically above this minimum variance portfolio, all this line from here up till this, right? This thing, right? But anything below this minimum variance portfolio is inefficient portfolios. Why? So for a given level of risk, say somewhere between 8 and 10, where you have 9%, right? You have the higher return somewhere over here. So if you will make such a portfolio with the weights in with the investment weights in such a way where you are generating from the 9% somewhere below the minimum variance portfolio over here, this level of return, that's not desirable. You need, for the same level of risk, you have a return available over here somewhere. So you need to find out what is that weight, so that if you appropriately manage the weight, means appropriately manage the investment between these two assets within the portfolio, you will have a higher level of expected return for the portfolio for the given level of the risk, right? So these line above over here, these are the efficient or desirable portfolios which you want, right? Now, one more important thing is the correlation. The shape of this line, this curve actually depends on the correlation. So I mentioned that it is good to have a negatively correlated asset. So you can see that. If you have more negative correlation, this curve will be more bendy towards the left hand side. Means you can have a situation where you have simply zero risk and a certain level of return. So for example, if I'll see -1, if it is -1 correlation, can you see over here? We can make up a portfolio where we have a zero risk and still just above 8% return, right? All this graph is basically getting like plotted based on the value over here. So the way I have linked over here in this formula is this, that once I'll change the correlation, this curve can change, right? So with zero, you can see that when they are uncorrelated, still we'll see the band, which is fine. We have a minimum variance portfolio over here. But what if it is we will have 1 + 1, the perfectly positive correlation? In that situation, we will not get any diversification benefit, and this is what I was telling earlier. So if you have +1, you can say there is a straight line. More you take risk, more if there is a more risk of the portfolio, there will be a more return. So you are not taking any diversification benefit at all. Anything below 1 actually will give you some benefit of the diversification, say 0.8, let's say. You can see that there will be a little bit of bend. That bend is not very prominent, but still there will be some bendy, it will be a bendy curve. You can see that it changed, right? Little bit it changed. So there can be a benefit with less than positively perfectly positive correlation if there is that exists between the return of the two assets. So now see, with 0.6 there will be much more bend, right? And in the original setting it was 0.1, right, like this. So now if it will be minus, say minus 0.25, it will be more bendy. Can you see that, right? So there is a diversification. If you on the number line between -1 to +1, if you will start moving, if the correlation start moving towards -1 from 1, if it is +1, then no diversification benefit. Anywhere between -1 and 1, not 1, then there is still the diversification benefit, even with 0.9 correlation between the return of the two assets. Why not you just the pause the video over here, or after the video create the similar graph and do this exercise on the Excel, where you have two risky assets. One is basically having the expected return of 14% and the standard deviation of 20%. The other one is 8% and 50%, and the correlation is 30. And see that how it's in like investment opportunity set is getting plotted. This is the investment opportunity set with this data. So whatever I have done on the Excel, you try it with this data and see if it is working for you. So just play with the number and try to regenerate this plot. So let me generate the similar thing over here. So the risky asset one has the 14% expected return, and its standard deviation was 20%. And the risky asset 2 has the return of 8%, and its standard deviation was 15%. And the correlation with was 0.3. So you can see that it is almost same sort of a curve over here. So you can play with this and try to generate the same Excel sheet on your own. So the main take from these last few slides is this, that the asset allocation matters a lot. If you will invest below the minimum variance level, then those are inefficient portfolios, and you do not want to invest in them, because for the given level of the risk, you still have the high level of return available with some different portfolio weights. So the above line, which is the efficient portfolio, that is actually desirable, and you want to invest and find out the appropriate asset weight, so that you will be able to invest in such a way where you have the maximum return for a given level of risk. So for example, in this case, you can see that for this level of risk over here, 14 point, which is basically 14.23, like this, there is some return available right up over here. So not should undertake 8.6% return, and you should take somewhere over here. So that level of return is desirable for a given level of risk. So anything below minimum variance, it's not desirable, and above this, it is desirable. Thank you.